Hey, welcome. Today we're going to tackle the world of insurance. Let's be honest, it can feel, well, pretty complicated, right? The language is often confusing, and it's hard to know what's what. We're going to fix that. So, to really get what insurance is all about, let's kick things off with a simple question.
Seriously, just imagine for a second, what if you could take all your biggest financial what-ifs? A car crash, your house flooding, a sudden illness, and you could share that burden with a huge group of people. So if the worst actually happens, you're not facing it all alone. That idea right there is the heart of insurance.
And honestly, this is the best way to picture it. At its core, insurance is just a giant shared piggy bank. Everyone chips in a little bit of money, and when someone in the group gets hit with a bad break, the money from that piggy bank is there to help them get back on their feet. That's the whole game, sharing the risk.
Okay, so like any big system, this community piggy bank has its players and it has its rules. Let's meet the main players and take a look at the rule book that holds the whole thing together. So first up, you have the insurer. Just think of them as the manager of our community piggy bank. They're the company that collects everyone's contributions and makes the promise to pay out when things go wrong. And then, of course, you have the insured. Yep, that's you. You're the one putting money into the piggy bank to get that protection so you can sleep just a little bit better at night.
So you're probably asking, how do I get in on this? Well, you pay what's called a premium. It's basically your subscription fee for that protection. And what's really interesting is how they figure out the price. It's all about how much risk is involved. For example, a healthy 25-year-old is going to pay a way lower life insurance premium than a 55-year-old because, statistically, the risk is just lower. It's the price you pay for peace of mind.
And the thing that holds all of this together, that's the policy. This is the most important document in the whole deal. It's the official rule book. It's the contract that spells out exactly what's covered, what's not covered, and all the conditions. So I can't stress this enough. Always, always read your policy. The devil really is in the details.
Now, this piggy bank protects against all sorts of different worries. And insurance basically comes in two main flavors. First, you've got property and casualty insurance, or P&C. The easiest way to remember this is that it's for protecting your stuff, your car, your home, that kind of thing. Then you have life insurance, and that's not about stuff at all. It's more like a promise you make to your family to make sure they're taken care of if you're not around anymore.
All right, so we've got the players, we've got the rules, but what exactly are we protecting ourselves from? To really get that, we need to understand the language of the what-if.
Everything, and I mean everything, in insurance starts with this one word: risk. Risk is just the chance that something bad might happen that's going to cost you money. It's that what-if that keeps you up at night, the chance your car gets stolen or your house floods. That's the problem insurance is built to solve.
But what makes one situation riskier than another? Well, that's where the idea of a hazard comes in. A hazard is anything that makes a bad outcome more likely. It doesn't actually cause the problem itself. It just, it stacks the deck. For instance, storing a bunch of petrol cans in your garage doesn't start a fire, but boy, if one ever does start, that hazard makes the whole situation way, way worse.
So, if a hazard sets the stage for a disaster, what's the thing that actually causes it? That, my friends, is the peril. The peril is the villain of our story. It's the fire, the flood, the theft, the earthquake. It's the active event that shows up, causes all the damage, and ultimately triggers your insurance claim.
Okay, we've set the scene, we know the players, the rules, and the dangers lurking in the shadows. So, what happens when that what-if, that peril, actually becomes a reality?
Well, when that peril finally strikes, what you're left with is a loss. This is the real, measurable financial damage you've suffered. It's the dent in your car, the water damage in your walls. It is the very reason you bought insurance in the first place.
All right, let's put some numbers to this to make it super clear. Let's say a peril, maybe a minor car accident, causes 1 lakh rupees worth of damage to your car. That is your total loss.
Now, here's a key part. Your policy almost always has something called a deductible. Think of it as your share of the cost. I love this analogy. If the total loss is a pizza, the deductible is the first slice, and you always pay for that first slice yourself. So in this case, you pay the first 10,000 rupees. And only after you've paid your part, your deductible, does the insurer step in and cover the rest. So they pay the other 90,000 rupees. It's actually a pretty smart system, right? It makes sure you have some skin in the game, and it helps keep costs down for everyone by discouraging a ton of tiny little claims. So notice something really, really important here. After the insurer pays up, you haven't made a profit.
you didn't win the lottery. This core idea that you're just put back to where you started but no better off is probably the single most important principle in all of insurance.
And this core idea has a big, fancy name: indemnification. But don't let the word scare you. The idea is incredibly simple. The whole goal of insurance is to make you whole again. It's designed to bring you back to the exact financial spot you were in moments before the loss happened. No better, no worse.
Okay, that was a lot of jargon, I know. Premium, peril, deductible. So let's tie it all together and see how it works in the real world with a quick story about a guy named Ravi.
So Ravi faces a risk of floods, which is made worse by the hazard of living so close to a river. So he buys a home insurance policy from an insurer. He's now the insured, and he pays his premium every year. Then one day, the peril he was worried about strikes, a massive flood. It causes a huge loss, damaging his whole ground floor. So he files a claim, pays his 15,000 rupee deductible out of pocket, and his insurer pays for the rest of the repairs. That's indemnification in action, making him whole again. See how all the pieces just click into place?
And there you have it. That's our quick tour of the insurance world. We started with this simple idea of a community piggy bank and saw how all these rules and players work together to get you back on your feet. So, now that you know the rules of the game, I'll just leave you with this one thought. What's the one what if in your life that you'd want to protect the most? Thanks for tuning in.